returns and assessment of charitable and religious trusts or institutions under the Income Tax Act 1961. We have our resource person, CA P.J.Johney. May I request our CA Roy Varghese, Chairman of our Ernakulam branch, to welcome resource person, other dignitaries and all the participants.
Very respected resource person, past Chairman of Ernakulam branch of ICAI, CA P.J.Johney sir, immediate past SIRC Chairman and Regional Council Member, CA K. sir, my colleagues in Managing Committee of Ernakulam branch, esteemed senior members, colleagues in profession and friends. Good afternoon to all of you. Today it is a special day for all of us. I don't know how many of you remember it. November 10th is International Accounting Day. In other words, the day of the accountants. On this day, let me wish you all accounting professionals a very happy day. We are discussing here today an important topic. The new challenges on registration under Section 12AB, returns and assessment of charitable and religious trusts or institutions under Income Tax Act 1961. Since the medium of charitable trust or institution is widely perceived as a tool of tax planning, the government has progressively made the law relating to taxation of charitable trusts very strict. In the recent past, government has tried to bring in more controls and restrictions to taxation of trusts under the tax net. The government, through these stringent rules and provisions, ensure that no income actually chargeable to tax of these charitable trusts and institutions escapes the tax net. Our learned resource person, P.J.Johney sir, will discuss with us the recent amendments in taxation provisions of charitable trusts brought in by the government and how it is going to affect the registration process, return filing, and assessment of charitable and religious trusts. We are quite sure the discussion today will update and refresh our knowledge on taxation of trusts and enable us in discharging our professional service in a better way. P.J.Johney sir is one of the dynamic past chairman of ICAI Ernakulam branch and is a very sought after faculty on direct and indirect taxes in Kerala. We are really happy to have his presence here today. On behalf of Ernakulam branch of ICAI, I extend Johnny sir a cordial welcome to this webinar. Welcome, sir. SIRC member and immediate past SIRC chairman, K. sir is part and parcel of Ernakulam branch. Sir is always with us in all our programs and activities, actively supporting us and guiding us and leading us and helping us. We are happy to have his presence with us today. I always tell that next year when Babu sir is vacating his office, we have only in sir our hope for the future. That's what I want to tell you now. On behalf of all of us present here today, I extend a warm welcome to say K. sir to this webinar. My colleagues in Managing Committee of Ernakulam branch of ICAI is present here today. I welcome Vice Chairman CA Ranjit Warrior and Secretary CA Jose KV to this webinar. Now it is my pleasure to welcome each and every one of the seniors and professional colleagues present here today to this webinar. Wish you all have a wonderful learning time today. I am quite sure the session will be very useful to each and every one of you. Thank you all for your patient listening. Over to CA Jose for the proceedings, please.
Thank you, Chairman CA Roy Varghese, for that welcome address. Before we go to the session, may I request our immediate past chairman and member of SIRC, CA K. George, to deliver his address.
Thank you, Jose. Before I do that, may I request Roy sir, the chairman, to inform the audience, the members about our upcoming Navaratna conference and request their presence in the upcoming major program.
Yes, sorry, I just missed it. We used to present our future programs later on. That is the reason why I kept it pending. Anyway, friends, from 16th to 25th of this month, all the Kerala branches together is organizing a program SCP program called Navaratna program.
Virtual
program it is, and it offers 20 CPE credit hours to those who attend all these 9 days program. The timing is from 3 to 5. It starts at 3 and it will normally end at 6 or 5 o'clock. But it's on the inaugural day and the last day we'll be having 3 to 6 sections. Eminent faculties. I'm quite sure eminent faculties and interesting topic very useful to all of us is being arranged. I take this opportunity to thank Jogan sir and Babu sir for all the support and in getting the faculties, in arranging the topics, everything. Both of them are helping us in a great way. So don't miss this chance. The rate is also, I think, the per day rate is also only 200 rupees plus GST. and for lump sum, for 20 hours, you need to pay only 1,400 rupees for all these 9 days, inclusive of GST. It's a great offer. You won't get it. So, register in advance. You can register in a respective branch sessions itself. In Ernakulam, those who are in Ernakulam, they can register here. Alapi, they can register Alapi itself. Likewise, all the 9 branches together we are doing it. So, make this a monumental event, join in advance and see that it is really useful to all of you. Thank you.
Roy sir, I want to add to that. For ARS members of Ernakulam, it's free.
Yes. It's absolutely free for ARS members of Ernakulam. Not only Ernakulam.
All the 9 there.
Yes, all the branches.
Joe sir, still there are some background disturbance. Now it's okay.
Okay, over to Johan sir.
Thank you, Dynamic Chairman of the branch, C. Roy Varghese, Secretary K.V. Jose. I think Ranjit is also there, the Vice Chairman, and the very learned speaker who is now enlightening us on his favorite topic, charitable institutions, registration and assessment. P.J.Johney. Johnny sir, I have the pleasure of working with him in the managing committee many years back, and he's a very, very focused, structured professional, upright professional, and rendering yeoman service, particularly in the areas of supporting non-profit organizations. So he's a true specialist, and I'm sure that this session will throw light on many of the contentious issues, as well as bring a new approach and a perspective to the topic on hand today. And Johnny sir, his hands-on experience in the audit, assessment, and advisory of all the many very large charitable institutions in the state and outside. I know we have traveled together, and also has served on the board of many of the charitable institutions, hospitals. Therefore, is the right person, doubtlessly. Thank you, Johnny sir, for offering your service after a long break, I think, to the Ernakulam branch. You should come closer to the branch. We would like to have your expertise and gain from that. And on the topic, yes, our chairman has set the tone for the topic. My compliments to the chairman. The registrations, of course, 160, and it is still ticking. 2 reasons: one, the topic; 2, the speaker. So naturally, and the chairman should also, and secretary, the managing committee should take credit for putting all the elements together. Now the topic is recently there are a lot of structural changes in the registration process. The 12-way registration, the ATG registration, which used to be kind of a lifetime. Now will all these registrations have to be renewed, and then they will have a life of 3 years, as we have seen in the last budget proposal. And assessment also going into faceless assessment and things like that. There are issues involved. There are restrictions on charitable institutions embarking on commercial transactions, the ceiling of 25 lakhs and so on. And the restriction on the big difficulty in getting the registrations, then 12BA and then later ATG. The topic is very, very important, and a lot of I can see in the audience, a lot of members and non-members, not only from Ernakulam, from outside. I think even from Kannur, I was seeing Jacob sir. So the name in the audience. So I'm sure that we'll have a wonderful session. My compliments to the branch once again, and thanking Johnny sir and every one of you for giving me the opportunity of interacting with you, and reiterating what Roy sir said. Next Monday onwards, 16th to 25th, excepting that one Sunday in between, 9 branches, 9 days. We have aptly named it as Navaratna Conference, and we have the best-in-class speakers signing up. The flyers would have already reached you from the respective Ernakulam and other branches. The detailed brochure, the timing, the topic, the chair, all those will reach you by tomorrow, latest by tomorrow. So looking forward to large participation. It's a state level conference. Let's make it a celebration. Honorable President and Vice President has also kindly consented to bless the inaugural as well as the valediction, and we are trying to bring in some public figure also into the whole process. So with that, let me conclude. Looking forward to a wonderful session. Johnny sir, thank you once again, and have a great learning time. Stay safe. As I always say, restraint, resilience, and resolve are the 3 things we need in these difficult times. But I can say one thing: we will overcome, and we shall overcome, and we will surely see better days to come ahead. Achhe din acha hai, aage hai. Thank you very much.
Thank you, Joman sir. Thank you very much. Now may I request our Vice Chairman, C.A. Ranjit Warrior, to introduce our Johnny sir.
A very good afternoon to all of you. I indeed take personal pride and pleasure to introduce you to somebody who doesn't need an introduction to our members. C.A. P.J.Johney sir has been in practice for over 31 years and owns and operates the chartered accountant firm Johnny and Company at Edapalli, Kochi. Is the past chairman of the prestigious past chairman of the Ernakulam branch of ICAI in the year 1999-2000. He has been a senior faculty and a member at the various advisory boards, various management, professional and technical institutions in the state of Kerala. He is a visiting faculty for MBA, MCA, for postgraduate diploma programs at various universities, management institutes, and also visiting faculty at the ICAI and ICWAI on finance and taxation. He is a corporate trainer and has presented papers at various seminars and workshops. He is also a consultant to various trusts, MNCs, corporates, government companies on GST, income tax, and other related taxes. He is also a member of the All India Management Association and KMA, Kerala Management Associations. With these little words, let me introduce you to somebody whom I personally have high regard and respect for. Over to you, Johnny sir. Over to you. Sir, you are on mute, sir. You are on mute, sir.
If you salute your duty, you need not salute anybody. But if you pollute your duty, you have to salute everybody. The words of Dr. Abdul Kalam, past President of India. Respected Chairman, C.A. Roy Varghese, SIRC past Chairman C.A. Joman, Vice Chairman C.A. Ranjit, Secretary C.A. K.V. Jose, senior members from all over India, participants from various non-profit organizations, and my dear friends. Today, my topic for discussion is on charitable and religious institutions and trusts relating to registration, returns, and assessment. Before I go to the details of income tax law, I would like to touch upon the different statutes in India which enables us to form a charitable trust or institution. We have public trust under the Indian Trust Act 1882, Bombay Public Trust Act 1950, societies under the Travancore Cochin Literary, Scientific and Charitable Societies Registration Act 1955, societies under the Societies Registration Act 1860, Section 8 company under the Companies Act 2013. So these are various statutes. Let me start with public trust under the Indian Trust Act 1882. This trust is under the act which was in existence before independence, 1882. So after independence also, this act is valid as per the constitution. Therefore, when you are forming a trust, you have to register with the sub-registrar, showing the name, objects, and all other requirements as per the income tax law and other statutory requirements. Bombay Public Trust Act 1950 is an act relating to public trust or any class of public trust and trustees, and it shall extend to the whole of Maharashtra. Societies under the Travancore Cochin Literary, Scientific and Charitable Societies Registration Act 1955 is extend to the whole of Kerala. Please note, it extends to the whole of Kerala except Malabar district. The object of the act is for the purpose of charitable activities, religious activities, scientific activities, literary, etc. Therefore, this act is applicable the whole of Kerala except Malabar district. Now, our question is, what happened to Malabar district? Friends, societies under the Societies Registration Act 1860 is applicable to Malabar district. Seven or more members or persons associated for any literary, scientific or charitable purpose or for any such purpose as is described in section 20 of the act may be subscribing their names to the memorandum of association and filing the same with the registrar. So in Kerala, the district registrar is empowered to register the societies under the Societies Act in Malabar area. Now finally, I will come to section 8 company under the Companies Act 2013. Earlier, it was section 25 company under the Companies Act 1956. It is relating to non-profit company and the object is promoting arts, science, commerce, research, education, sports, charity, religion, social welfare. The profit or any other income should be used in promoting the above objects. No payment of dividend to be members of the company. Minimum 2 members, maximum 200. There is no strict shareholding pattern. The liability of each member or shareholders is limited. If a company faces loss under any circumstances, the personal, individual assets of the shareholder are not at risk. The company is headed by a board of directors. It should have minimum 2 and can have maximum 15 board of directors. There is no minimum paid up capital of the company, but it is advisable to start a company with paid up capital of 1 lakh and authorized capital of 10 lakhs. With that, I have explained different types of statutes to enable us to form a charitable trust or institution or public or a religious institution or a religious trust. So this is a basic information which all of us should know, which is applicable to different states under different societies or Societies Act. But as far as Indian Trust Act 1882 is concerned, it is applicable all over India. As far as Societies Registration Act 1860 is concerned, it is applicable all over India. Whereas Bombay Public Trust Act is applicable only in Maharashtra, and other two cases with regard to Travancore Cochin, which is applicable only all over Kerala except Malabar district. With that, friends, let me start with the income tax. As per section 215, charitable purpose is defined: relief of the poor, education, medical relief, preservation of environment, preservation of monuments. Charitable purpose is redefined. It is provided that object of general public utility will qualify activities as charitable if such activities undertaken in course of actual carrying out of advancement of object of general public utility, and the aggregate receipts from such activity or activities during the previous year do not exceed 20% of total receipts of the concerned trust or institution. And this amendment will be applicable from assessment year 2016-17. Therefore, the charitable purpose includes education, and also we are able to do the public utility services, and which is limited to 20% of the total receipts of the concerned or trust or institution. So the object of the definition of charitable purpose is very, very important for the purpose of subsequent discussions. Now, straight away, I will go to registration. Friends, section 12 provides for registration. Section 12A is also provides for registration. 12AA is also provides for registration. Now, section 12AB is also provides for registration. So, section 12 provides for exemption and registration, which is a mandatory requirement for claiming exemption, and 12A is the requirements of registration, and 12AA is the procedure for registration. Therefore, in earlier cases, we might have seen registration under section 12A, a single sheet of paper showing the trust or institution is registered with the Commissioner of Income Tax. A number is also allotted. But when you get a 12AA registration certificate, it contains all the terms and conditions of registration and requirements of comply with the statutes. 3 or 4 pages are there for the purpose of registration certificate, which means that merely by obtaining a registration under section 12AA is not at all sufficient to claim exemption from income tax. Friends, at this point of time, I would like to mention that the purpose of granting exemption for non-profit organization is to do charitable and religious activities in India, within India, which means that the government of India is not able to provide all relief to the poor or medical relief or education or charitable and other religious activities or relief activities, helping the old age people, helping the orphans, helping the differently disabled people in the state, in our country. Therefore, government is thinking about the association of or the support of non-profit organizations for doing charitable activities in our country. Which means that whatever exemption given under the income tax law, whatever savings out of exemption in respect of the institutions or trusts, they are bound to utilize that money for charitable purpose. So the NGOs or non-profit organizations are partners of the country for providing charitable or other helping hand for the nation. So this is very, very important because most of the non-profit organizations are not aware of this important factor. What are the conditions for granting registration? It should be, the activities of the institution should be within India. The fund should be invested in accordance with the section 11.5 of the Act. What is section 11.5? It is very clear. You have to invest in scheduled bank or nationalized bank, or you can purchase landed property, you can purchase building for the purpose of carrying out the activities of the organization, not as a real estate business. So you can invest the money in accordance with the section 11.5. At this point of time, I would like to mention about the investment in societies. Friends, as per section 80P of the Income Tax Act, the societies are eligible for deduction under chapter 6A. So the matter was considered by the Income Tax Department, and the claim of exemption under section 80P was denied on the ground that these cooperative societies are conducting banking business. At that point of time, the societies has given a statement to the High Court or the judiciary that we are not conducting any banking business. We are conducting only credit facilities to our members. But when you come across section 11.5, the investment should be in a cooperative society conducting banking business. When the societies are claiming that they are not conducting banking business, then investment under section 11.5 is not correct. Therefore, the matter is pending before the Honorable Court, and if the court found that it is not a banking company, then investment under section 11.5 is a violation. If the court found that the societies are running banking business, then it is as per section 11.5. Therefore, it is not advisable to deposit money in cooperative banks which are under dispute before the Honorable High Court of Kerala. Then, no discrimination as to caste, creed, color, sex, etc. Non-profit motive, apply purely for objects, no distribution of income or property directly or indirectly for the benefit of persons specified. That we will discuss later. I am talking about the conditions for granting registration. And of course, audit is compulsory under section 12B, 12AB, and audit is compulsory, audit report is compulsory. Every 31st March you have to file your audit, you have to prepare the audited accounts as on 31st March. Audit report in form 10BB in the case of institution claiming exemption under section 1023C. No amendment without prior approval of the Commissioner of Income Tax as recently modified for the purpose of modification of objects. You have to get the prior approval from the Commissioner of Income Tax. Transfer of funds to similar institution at the time of, or transfer of property to similar institution at the time of winding up. Here I must say that in the trust deed or the society memorandum, there must be a clause as in the case of amendment. So the clause should be in such a manner that in the event of winding up of the institution, the surplus or the property as on the date of winding up shall be vested with the government or shall be transferred to another trust having 12AA registration with the similar objects. No part of the income should endure directly or indirectly for the benefit of the settler or other specified persons as per section 13(1)(c). This also we will discuss later. What is section 13(1)(c)? The effect of registration under section 12AA is that the registration is valid in the previous year in which the application was received. That means it is with effect from the first day of the financial year. So therefore, the conditions to be shown in the deed or memorandum or bylaw of the trust or society for applying 12A or 12AA certificate. So all the statutory requirements as per income tax law should be provided to enable you to get the registration under section 12AA. I will come to 12AA later. So most important requirement is timely filing of return of income as per section 13(9). If you fail to file your return of income within the time limit, the exemption will be denied. There are so many other matters which are also provided under 12AA for the purpose of fulfillment of the requirements of getting exemption. With regard to cancellation of registration, the person who has issued a certificate only have the power. Where the Commissioner of Income Tax, Commissioner of Income Tax is the authority for granting registration. One state, one commissioner. So in the case of Kerala, Commissioner of Income Tax exemption Kochi is the authority to grant the registration under section 12AA. In the case of Chennai CIT exemption. In the case of Andhra Pradesh, or every state there is a Commissioner of Income Tax exemption. So if the commissioner satisfied that the activities of such trust or institution are not genuine or are not being carried out in accordance with the object of the institution, your registration will be cancelled. Friends, with effect from 1st September 2019, where a trust or an institution has been granted registration or has obtained registration at any time, and subsequently it is noticed that the trust or institution has violated requirements of any other law. Please note, any other law which was material for the purpose of activities of its objects or achieving its objects, and the order, direction or decree by whatever name called, holding that such violation has occurred has either not been disputed or has attained finality, the principal commissioner or the commissioner may, by an order in writing, cancel the registration of such trust or institution after affording a reasonable opportunity of being heard. Friends, this is very, very important. Any other law, violation of any other law, violated the requirements of any other law includes Provident Fund, ESI, or banning of unregulated deposit scheme, or any other law applicable in India enacted by the Parliament or by the State Assembly, and which has been disputed or attained finality, the Principal Commissioner or Commissioner may by order in writing cancel the registration. Therefore, it is a regulatory mechanism to monitor the charitable and religious institutions in India to comply with all the requirements for the general public. I have already mentioned banning of Unregulated Deposit Schemes Act 2019. I don't know how many of you are aware of this. This is a new enactment by the Parliament with effect from 21st February 2019. In India, we have various charitable or non-profit organizations. Many organizations are helping the poor people. Many are accepting deposits and granting loan to self-help groups, etc. So the acceptance of deposit, which is unregulated as per this act, is a violation. Therefore, if you come across any cases where you have accepted deposits which are banned by Unregulated Deposit Scheme Act 2019, you have to refund, you have to close that activity and comply with all the statutes. Therefore, violation of any other law, including Foreign Contribution Regulation Act, you are also well aware of the Foreign Contribution Regulation Act. Recently, we have conducted the seminar by our Institute of Chartered Accountants of India, Ernakulam branch. You might have seen the requirements of new registration procedure or renewal of registration or opening a bank account with the Delhi main branch of State Bank of India. Why this mechanism or why this regulation is tightened? Today, crores of rupees are coming from abroad and there is no proper mechanism to monitor the fund. Therefore, government is of the view that they can also monitor by collecting entire foreign contribution in a single branch of State Bank of India, Delhi branch, and from there you can transfer to your existing foreign contribution regulation account and you can do your activity. So every minute or every moment the government is able to monitor the fund. If you are failed to file the return, government doesn't matter, they will find out how much money you have transferred, how much money you have got out of this foreign contribution transfer amount. Therefore, this regulation are very, very important with regard to the total discipline, financial discipline in our country. Therefore, there is no question in blaming the government. But government can also consider a foreign contribution regulation account in branches of State Bank of India. They can also consider in this manner that foreign contribution regulation account can be opened in any branch of State Bank of India, which would have been more convenient for the general NGOs. But still, you can approach your branch to help you to open the account with the State Bank of India, Delhi branch. So, due to core banking facilities, information technology, it is not a difficult problem for you to open a bank with the State Bank of India, Delhi branch through your branch locally available. Therefore, it is not a big problem. What I wanted to tell you is that with effect from 1st September 2019, please make this date very, very important. Violation of any other law amounts to cancellation of your certificate under section 12AA. Any other law means any law applicable in the state or all over India. Example I have already mentioned, the Provident Fund, ESI, banning of unregulated deposit scheme, Foreign Contribution Regulation Act, Minimum Wages Act, so and so. You have other laws like building tax, profession tax, cess. All these are also enacted under different statutes. Therefore, any other law is not properly defined, but all other laws. Very, very important. Additional ground have been provided to be taken into consideration at the time of granting of registration and subsequently to allow the commissioner or principal commissioner to cancel the registration of the trust or institution. You can always see in the Act, Section 11, Section 12, Section 13. These are the main important sections connected to charitable and religious trust. There they have mentioned trust or institution. That is the reason why I have mentioned this Indian Trust Act, Bombay Public Trust Act, Societies Registration Act, Travancore Cochin Registration Act, and Section 8 Company. There is a trust or institution which includes all these categories. At the time of granting the registration or to a trust or institution, the principal commissioner or the commissioner shall inter alia also satisfy himself about the compliance of the trust or institution to the requirements of any other law which is material for the purpose of achieving the objects. Please see, at the time of granting the registration also, they will see the any other law. 1/9/2019. Renewal of registration. Friends, we have about 243 delegates attending this program, which means maybe more than, because one connection may be used by 2 or 3 people. Therefore, it may be 400 or 500 people are using this program. So I am very happy to share my knowledge with you with regard to this charitable and religious institutions connected with income tax law. So if you come across any questions, you can chat in the bottom right corner any point of time. I am not able to see you, therefore you can chat at any time. I am very happy to answer to your questions. Now friends, we have section 12 AB, 1023C and 80G. This will keep a check on inactive registrations. In India, there are numerous trusts, numerous institutions. Most of the institutions are not very active. Those institutions are not required to continue. Let them go. Only genuine and active institutions should continue. Therefore, government is planning to grant registration only for a provisional basis. And also, the existing registration, they wanted to renew it for a period of 5 years. Presently, there is no such a requirement of renewal. Now, the registration under section 12AA, approval under section 1023C and 80G were given without any expiry period. These registrations and approval shall be given only for a limited time period of 5 years. On expiry of 5 years, the registration approval has to be re-obtained, which means initially for 5 years, then again you have to renew for another 5 years. So, in short, what I wanted to tell you is that section 12AB is amended to section 12AA is amended to section 12AB. That is a procedure to be followed. Therefore, with effect from 1st April 2021, all the existing NGOs having registration under section 12AA or 12A or 1023C approval or certificate under section 80G, they have to apply for renewal. On receipt of the application in a prescribed form, at this point of time, I should tell you that there is no prescribed form so far. To my knowledge, there is a form applicable under section 12AA, that is form number 10A. For section 12AB, in my view, the government should issue another application in a prescribed form corresponding to change in rule under the income tax rules. So a prescribed form, we have to use it for renewal, and application should be given to Principal Commissioner of Income Tax or Commissioner of Income Tax. And this Commissioner of Income Tax will pass an order for registration approval. For registration means 12AA. Approval means 1023C or 80G. And it is for a period of 5 years. The order for registration bar approval in such cases will be required to be passed within 3 months from the end of the month in which the application will be filed. Please note, once you file an application, within 3 months, the Commissioner of Income Tax will pass an order extending the period of registration for another 5 years, and thus 3 months is counting from the end of the month in which the application is filed. The new approval or registration will be applicable from the assessment year from which the approval or registration was originally granted under the existing provision. As you know, section 12, section 12A, section 12AA, there are registration certificates. And this 12AA for 5 years is valid from the beginning of the registration as per the old provision. Now, government wants more control by rationalizing and digitalizing the process of registration. In order to simplify the compliance for the new and existing charity institutions, they will issue an electronic number which is called a unique registration number, URN, for all existing institutions. Kindly note, all existing institutions will be granted a unique registration number which is called a URN, which provides control to the government for monitoring this NGOs. The step will simplify the compliance for the new and existing charity institutions, and it will introduce uniformity in the registration process and promote ease of doing. Therefore, once you go through the number, you will be able to know this institution is located in which part of India. Therefore, it is a control mechanism where you are going to get the monitoring mechanism of the government of India. Now I will go to the application by new applicants. The provisional approval may be granted for the period of 3 years without any discretion in the hands of the authorities for any period less than 3 years. That means without any inspection, all the application will be considered and granted provisional registration for a period of 3 years, which means the department would like to monitor or like to watch your activities for a period of 3 years by giving a provisional registration, not a permanent registration. The first time applicants will not be directly given full or final registration, but will be granted only provisional. Later, the registration or approval may be granted following the prescribed procedure. At that time, they will verify, they may also visit your premises, they will also verify the original documents, they will also verify your audited accounts and activity report. And also they will study the promoters, the authorized signatories, the trustees, the office bearers. The application for fresh registration under 12AB or 1023C or ATG is to be made at least 1 month prior to the commencement of the previous year, relevant to the assessment year from which the said approval or registration is sought. Kindly note this. The application should be filed 1 month prior to the commencement of the previous year. This was not there in under section 12AA procedure. Under the section 12AB procedure, please note this as 1 month prior to the commencement of the previous year, relevant to the assessment year. No requirement for any detailed inquiry for the purpose of approval. That is with regard to new cases. Now, there is another amendment under section 80G. As you all know, 80G is a facility given to the donee for accepting the donation from donor, and the donor will get the benefit of deduction from his total income or gross total income. Therefore, there are cases where the donors are giving cash or the donors are getting certificate from the donee, and there is no proper mechanism to verify the genuineness of the transaction. Therefore, there is a new amendment which is very, very important. Otherwise, the donor will not get any deduction. It is possible only if a statement is furnished by the donee, who shall be required to issue a certificate in respect of donation received to the donor. And in the event of failure to do so, the fee and penalty shall be levied. That means it is as good as we are doing the process of tedious return. We are deducting tax, paying tax, and filing a return for the purpose of tedious. Like that, when the donee is receiving money from the donor, he has to prepare a statement, and that statement should be filed electronically. And on the basis of that statement, you will get, the donor will get the benefit of deduction under section 80E. So the genuineness of the transaction can be monitored by this mechanism. Now, what are the documents required for registration under section 12AB? Number 1, copy of trust deed or bylaws if it is registered, copy of certificate or other evidence of registration of society or a trust. 3, most of the religious institutions in Kerala are normally not registered as society or a trust or a charitable company. In such cases, there is no trust deed or society bylaw or memorandum. Therefore, this is my view, is that a deed of declaration of the trust from the religious head may be sufficient. So we will be able to know the exact requirements only after prescribing the form under form 10A or whatever may be, or amended form in form 10A. So presently, a document is required for the purpose of proving the objects, terms and conditions of the trust or society, then the duties, powers, then the opening of bank accounts, then all statutory clauses which are required under the income tax law for granting 12A registration, etc., are required to be shown in a declaration of trust deed. Only a sanction letter or an appointment letter from a religious head may not be sufficient for granting registration under section 12AB. This is my view. Number 4, a brief note on objects and activities of the institution. Number 5, copy of existing order under section 12A or 12AA. Number 6, list of office bearers with the full address, PAN, Aadhaar card, number, etc. Number 7, copy of PAN of the institution. Number 8, copy of accounts of the institution for the previous 3 years, audited accounts for 3 years. Number 9, copy of FCRA registration order if FCRA order is available. Number 10, full name and address of the institution with the building number, post office, district, PIN code, etc. should be shown in the application. Here I have 2 comments. Number 1, the name of the institution and the name of the office bearer should be same in all the documents like PAN, Aadhaar card, seal, letterhead, etc. Now we can see various issues relating to this. In various cases, the name as per PAN card is different from the name as per Aadhaar card, which is very, very important. And linking of PAN with the Aadhaar card and attaching the mobile number, etc. are very important. Therefore, what is the remedy? A common mobile number. So, as you know, the mobile number may be obtained and that number may be dedicated for the institution. And the email ID should be created not for the email ID of the individual trustees or office bearers. An email ID of the institution may be preferable and should be mentioned in the application as contact number instead of personal mobile number and email ID. Therefore, a uniformity, continuity in mobile number, email ID, etc. will help you to receive notices in future, because in future you are only getting electronic notices. Therefore, this notice will go to the concerned person if it is used by if the email ID or the mobile number is given in the name of the concerned person. Therefore, a dedicated mobile number and a dedicated email ID is very important. And moreover, the PAN card and Aadhaar card of the trustees or office bearers should be same. If there is any difference, better to get it corrected, and the address is to be shown properly. The seal also should be proper. Therefore, from 1st April 2021 onwards, you may follow all these procedures to run the institution without any complication. As all of you know, what is 1023C? As per section 1023C 3AD, any university or other education institution existing solely for educational purposes and not for the purpose of profit, if the aggregate annual receipt of such university or education institution do not exceed the amount of annual receipts, which is notified as 1 crore rupees. If it exceeds 1 crore, you have to get a certificate under section 1023C from the Chief Commissioner of Income Tax. Here also, under section 1023C 3AE, any hospital or other institution for the reception and treatment of persons suffering from illness or mental defectiveness, or for the reception and treatment of persons during convalescents or persons of requiring medical attention or rehabilitation existing solely for the philanthropic purpose and not for the purpose of profit, and which is wholly or substantially financed by the government, if the aggregate annual receipt of such hospital or other institution do not exceed the amount of annual receipts, that is 1 crore rupees. Therefore, this one is for education, another is for medical relief for hospital. On these grounds, if the total receipt, gross receipts means the amount shown in the income and expenditure account right hand side as total gross receipts, not in the net amount, net surplus, gross receipts. If it exceeds 1 crore, you have to get prior approval from the Commissioner of Income Tax, the Chief Commissioner of Income Tax, for getting total exemption, in which the application of 85% is not applicable. So in those cases also, the renewal is required. Now I will come to ATG once again. I have mentioned the monetary mechanism, and further up to rupees 2000 can be donated in cash, higher amounts by check or money transfer. If you want to get the benefit of deduction under section 80G, and if the amount exceeds 2,000 or more, then you have to pay by account by check or account by demand draft or account by or money transfer through banking system. No ATG benefit if donation is received in kind, and ATG institution cannot donate to another ATG institution for the purpose of getting ATG benefit. You cannot donate to another institution for ATG benefit. Therefore, this is with regard to ATG. In future, ATG registered institution should intimate the Income Tax Department quarterly statement, which is I already have mentioned, for the purpose of claiming deduction under section 80G. Therefore, I have mentioned about the application for renewal for existing institutions or trusts under section 12AB. I have also mentioned the procedure for new application for registration under section 12AB, and also mentioned about the approval under section 1023C and approval under section 80G. Now let me come to corpus donation. What is corpus donation? A corpus donation is a donation with a specific direction. Then, if you are getting a corpus donation or a specific direction, donations are to be excluded in computing the income for 80% of application. For example, if you are getting 1 crore rupees for constructing a conference hall or an auditorium in a school, that 1 crore rupee is for a specific purpose. That is called corpus donation. And you are getting income 1 crore rupee, you show it as gross income, and you can also show it as 1 crore rupee as application. It is not applicable with regard to 85% application. Nothing to worry, we will come to 85% application on later date, later discussion. Any amount paid or credited to any other trust or a corpus, then it shall not be treated as application of income. Dear friends, this is very, very important with effect from 1/4/2018. If you are a charitable trust or institution registered under section 12AA and you are paying or crediting to another trust, which is also a trust registered under section 12AA, that donation, corpus donation to another trust is not an application. Therefore, corpus donation from one trust to another trust is not treated as application of income with effect from 1/4/2018. You may be asking me that whether general donation is possible. The answer is yes. This is only restriction with regard to corpus donation. What is corpus donation means? A specific direction. If there is no specific direction, it is called a general donation. So, general donation from one trust to another trust is eligible as application of funds. So, this is very important. Now, let me come to anonymous donations. Section 115, capital B, capital B, capital C. Anonymous donation means a person receiving contribution does not maintain a record of identity, which means there is no PAN card or Aadhaar card or electoral card or license. There is no proof proving his address or any other particulars. So, which is called anonymous donation. An anonymous donation is a donation where the details of the donor is not identifiable. In that case, anonymous donations are liable to be taxed at 30%. Suppose you are getting a donation of 10 lakh rupees, 3 lakh rupees to government, 7 lakh rupees to you, 30%, 70%. That's all. 115 BBC, anonymous donation. But there is exemption to that. Exclusions are, if the trust is wholly religious. Number 2, trust or institution is covered by section 1023C. Number 3, 5% of total donation received by the assessee or rupees 1 lakh, whichever is higher. To that extent, it is excluded. Having said this, let me go to the next item, that is called filing of returns. As all of you know, financial year 2018-19, which means assessment year 2019-20, audit report should be filed on or before 30th November 2020 and income tax return should be filed on or before 30th November 2020, both on same date. Earlier there was so much time, but due to COVID-19, the time limit is extended up to 30th November 2020. Those who have not filed the return for the financial year 2018-19, you have a golden opportunity to file the return before 30th November 2020. You are getting so many mails, SMS, notices, and also information through channel that you utilize this opportunity. Friends, I must say that if you want to run any institution in India as a charitable or a non-profit organization, you must comply with the income tax and other laws. Without filing income tax return, you cannot function the organization in India. If your income is or your receipt is with a minimum level of 2,50,000 and all, it is, you can forget about that. But even then, if you want to grow, you should file the return. In today, filing of return is mandatory, my dear friends. Therefore, all of you should make a postmortem and see whether your trust or society is complying with the statutes, particularly filing of return. You have the golden opportunity. I must repeat, financial year 2018-19, you have time this month end, November 30th. Please remember. Now, 2019-20, you have time up to 31st December for audit report, 31st January for ITR, income tax return. Please note these two important dates. Because of COVID-19, government is very liberal in granting time. Now, how to compute your income? Having said the due date, I must say about the computation of income. In normal cases, like business income, we used to compute the income tax by taking the profit as per profit and loss account or profit as per income and expenditure account, business organization. But in the case of charitable or religious trust, as per section 11, 12, 13, the gross income or the income means gross receipts. Section provides income. Income means gross receipts. Those who are attending from various parts of India and not familiar with this P&L account and balance sheet, please note that in the income and expenditure account, right hand side, you are showing income. That income is to be taken as gross receipts, not the net profit, not the income minus expenditure. Let us say 100 rupee is the gross receipts, out of which you have spent 70 rupees for revenue expenses, 15 rupees for capital expenditure like land, building, furniture, etc. Your total expenditure, total payment is 85 rupees and the surplus is 15 rupees. So 15 rupees is the surplus as per section 11 subsection 1 of the Income Tax Act. You are eligible to claim that 15% of the gross receipts as deduction. Even if you have not spent that money, no tax is payable. Therefore, it is a deduction from gross receipts 15%. So 85 rupees you have spent, 15 rupees not spent, your total income is 0, no tax is payable. So 85% is to be applied. Now, this is another example where gross receipts from all sources is 100 rupee. Amount applied for charitable purpose, that is day-to-day expenses 50 rupees. Land, building, furniture, etc., which is called capital expenses 25 rupees. Total is 75 rupees. Surplus is 100 minus 75, 25 rupees. And friends, out of it, your deduction is 15% of gross receipt, 15 rupees. Therefore, there is a surplus of 10 rupee even after applying deduction of 15%. Therefore, 25 minus 15, 10 rupee, that 10 rupee is taxable. But as per Income Tax Act, explanation to section 11, subsection 1, clause A, you can accumulate for the next year by filing a prescribed form electronically in form number 9, capital A. Please note that this 10 rupees should be available in your bank account. It should not be given to others for advance. It should not be given to any cooperative society for deposit. It should be in your scheduled bank or nationalized bank or the manner prescribed under section 11(5) of the Income Tax Act. If these conditions are satisfied, then you can claim deduction and no tax is payable. Now friends, we have another case. Gross receipt is 100 rupee. Amount applied for charitable purpose, revenue expenses 25 rupees, capital expenditure 25 rupees, total 50 rupees, balance surplus is 50 rupee, and this 15 rupees is the standard deduction of 11(1), 15%. So 50 minus 15, 35 rupee. This 35 rupee can be accumulated over a period of 5 years. At that point of time, you have to file form number 10 electronically. A minutes is required in the meeting of the board of directors or board of trustees, and there must be a specific purpose for that. You have to take a decision how to accumulate, how to utilize that accumulated money. Moreover, you should know that this 35 rupees is available in the manner prescribed under section 11(5). Now, we have returns. For calculation of amount exempt under section 11(1), 15% of gross receipt should be considered and not net surplus. So in the case of returns, I will go back once again in this computation. You have seen that the 35 rupees is deduction. I repeat, for calculation of amount exempt under section 11(1), the amount you can see 15% gross receipts everywhere, 15% of 100 rupees. But it is not 15% of surplus, it is 15% of gross receipts. And supporting to this view, there are different tribunal orders, High Court orders. I have mentioned order number 662 Bangalore bench, 364, 240, 241, which means for the purpose of computing 15%, you have to take gross receipts. Now, I would like to mention certain common areas. Cash receipts more than rupees 2 lakh, section 269 ST. Rest is a person receiving 2 lakh rupees or more in cash from a person in aggregate in a day or in respect of a single transaction. Now, what I wanted to tell you is that this provision is also applicable to charitable and religious trust, which means in a day from in a person, the limit of 2 lakh is applicable as per section 269 ST. And penalty under section 271 DA is also important, equal amount. Now, for making a summarized presentation, I would like to mention the interplay between section 269 ST, 269 SS and 269 T. All of you know what is section 269 SS, 269 T and 269 ST. But those who are not familiar with this section, because we have about more than 237 connections, maybe 400 participants. Therefore, there are also members from non-government organizations or non-profit organizations. So for the benefit of all of them, I would like to mention that section 269 SS provides for acceptance of deposits of rupees 20,000 or more. 269 T, repayment of loan or deposits, rupees 20,000 limit. 269 ST, 2 lakh rupees towards services received or goods supplied. So I would like to say that 269 SS is connected with the loan, 269 ST is connected with the loan, 269 SS acceptance, 269 T repayment, whereas 269 ST is related to receipt of money towards services provided or material or goods supplied. So if you violate this provision, this penalty under section 271D, 271E, 271DA, equal amount is applicable. Therefore, this is also applicable to charitable and religious institutions. So please don't confuse with the 2 lakh and 20,000 rupees. I repeat, 20,000 rupees is for acceptance of loan or deposit. 269T provides for repayment of loan or deposit, whereas 269ST relating to receipt of money from a single person in a single day, 2 lakh rupees or more. Which means that, for example, if you are running a charitable institution as a hospital and the operation charges rupees 3 lakh rupees, and you cannot collect 3 lakh rupees in cash from the patient. This is an example of 269ST. You have to collect it through account pay check or bank transfer or account pay demand draft, etc. So this is very, very important. Moreover, when you are purchasing and selling properties, this section is also important. The section was further amended. In the case of immobile properties, when you are purchasing a property, you cannot make payment more than 20,000 by cash. It should be by account pay check or account pay demand draft or bank transfer. So section 269T or SS or ST are very much applicable in the case of charitable and religious institutions. Having said this, let me go to the importance of TDS, tax deducted at source. Very, very important. All are important, but this is also very important. You have to understand the concept. That is very, very useful. I remember a person who has made an observation and telling that a person shared his experience and stated that he has been following the teachings of Gita for the last 31 years. The other person who heard this was very much happy with this statement from this person. So he thought he is a very nice man following Gita. There was another person who was sitting adjacent to him, and he said he was talking about his wife. His wife's name is Gita. Therefore, friends, understanding the concept is very, very important for executing or complying with these statutes. This man was following his wife for last 31 years, not following Gita. Therefore, clarity is very important. Now, let us consider the consequence of non-deduction of tax at source. All of you know TDS. Section 192 is for salary. All assessees who are employees must deduct tax at source for all employees having taxable salary at the time of payment. The assessee shall furnish to the evidence or the particulars of the claims referred to in form number 12BB for the purpose of estimating his income or computing his tax. So in the case of salary, you have to compute the estimated income and you have to compute the tax payable for the year, divide by 12. That is applicable under section 192, TDS on salaries. Now, with regard to TDS under section 194C, that is with regard to contractors, TDS on contractors. Any person responsible for paying any sum to any contractor and subcontractor for carrying out any work, including supply of labor for carrying out any work, must deduct at source, wherein the consideration exceeds rupees 30,000 for a single contract and aggregate of such sum during the financial year exceeds rupees 1 lakh at the time of credit or payment, whichever is earlier. Most of the institutions are not properly complying with this TDS provision under section 194C. So the consideration exceeds 30,000 for a single contract and aggregate of such sum during the financial year exceeds 1 lakh. What is the TDS rate? The TDS is applicable at the rate of 1% in the case of individuals and 2% in the case of others. Others means company, partnership firm, etc. So what is meant by work? Work includes advertising, broadcasting, telecasting, etc., carriage of goods or passengers, catering, manufacturing or supply of product according to the requirement or specification of a customer, etc. So all these are coming under work and subject to TDS. And the rate of TDS I have already mentioned. TDS is applicable at the rate of 1% in the case of individuals and 2% in the case of professional charges. I repeat, TDS is applicable at the rate of 1% for individuals and 2% for others. Others includes company, partnership firm, association of person, trust, in society, etc. But please note that due to COVID-19, the government is more liberal. So government says in the case of TDS, you deduct only 75% of the rate prescribed. Therefore, 25% relaxation. And please note that this is valid only up to 31st March 2021. With regard to technical services or professional services, 194J is applicable and the rate is 10%. Now, only for financial year 2020-21, only up to 31st March 2021, the rate is 7.5%. TDS on sale of land, very important. All are important, but this is very important because the money involved is very high. Any person being a transferee responsible for paying other than the person referred to section 194 LA to a resident transferor. Please note, many people are not very clear about it. Section 194 IA provides the TDS at the rate of 1% to a resident transferor. Any sum by way of consideration for transfer of any immovable property other than agricultural land. Agricultural land is exempted. You have to prove that it is an agricultural land by the village officer or by the agricultural officer. If that be the case, the rate is 1%. And the amount should be paid to the government account by way of challan. In the case of 2020-21 up to March 2021, the rate of TDS is 0.75% instead of 1%. But friends, this section 194 IA is not applicable to non-resident. If the seller of the property is a non-resident and the buyer of the property is a resident, then section 195 is applicable. And if you want to claim exemption, you have to apply to the income tax officer under section 197 for claiming concessional rate or non-deduction of tax at source. No deduction under subsection 1 shall be made where the consideration for the transfer of an immovable property is less than 50 lakh rupees. That means if it is 50 lakh rupees, 1% or 0.75% is applicable. Less than 50 lakh rupees, no TDS is applicable, including agricultural land. TDS on cash withdrawals. This is also very important. Section 194N, responsible for paying any amount, aggregate amount as the case may be, in cash exceeding rupees 1 crore rupees during the previous year to any person from one or more bank accounts maintained by the recipient at the time of payment of such sum, deduct at the rate of 2%. Friends, 194 N is applicable with effect from 1st September 2019. Cash withdrawal exceeding rupees 1 crore, 2% TDS. Subsequently, in the case of recipient who has not filed the returns, 1/7/2020, this provision has been amended. How it is amended? The recipient who has not filed the return for all the 3 assessment years relevant to the 3 previous years for which the time limit of return of income under section 139(1) has expired, immediately preceding the previous year in which the payment of the sum is made to him, the provision of this section shall apply with the following modification. What is a modification? There it says, the sum shall be the amount or the aggregate amount as the case may be in cash exceeding rupees 20 lakh. It is not 1 crore. With effect from 1/7/2020, the limit is not 1 crore, it is 20 lakhs. The 20 lakh is applicable only in persons who have not filed the return for the 3 consecutive previous years. Others, this 1 crore is applicable. So please make it very clear the difference between 20 lakh and 1 crore. Both are clear, same, both are very clear. 1 crore is applicable to those who are withdrawing cash. 20 lakh is applicable to those who are not filing return for the last 3 years. So that is with effect from 1/7/2020. Next. For the purpose of determining the amount of application under clause A or clause B of the provisions of subclause IA of clause A of section 40, what is intended to do it with regard to computation is that if you are not deducting tax at source, you are liable to pay tax out of your pocket, equal amount as penalty, interest for delay in payment of tax. These are the consequences. And moreover, there is a rigorous imprisonment for a period of 6 months. So, or maximum up to 6 years like that. Imprisonment is also applicable. Now, what I wanted to tell you is that over and above that liability to pay TDS and the liability to pay penalty and the liability to pay interest, your income will be computed in this manner. What is the manner? The expenditure will not be allowable as if TDS has not been deducted. After deduction, not paid. So, if it is deducted, if it is not deducted, or if it is deducted and not paid on or before the due date as per the time limit for filing the return under section 139(1), this expenditure will be not be allowed and it will be taxable as profits and gains of the business or profession like that. The manner in which it is computed under profits and gains of business or profession. Why it is mentioned like that? Because section 40A IA and 40A3 are coming under the chapter business or profession. Therefore, this expenditure will be disallowed and income will be computed accordingly. If TDS is not deducted and paid or deducted or not paid, under these circumstances, 30% of the amount will be disallowed and on that 30% will be taxable. For example, if your the payment is 2 lakh rupees to the contractor and you are not deducted tax, your tax deduction may be 1%, 2,000 rupees, whereas you are liable to compute your income by disallowing 30%. Therefore, 2 lakh into 30% is equal to 60,000. On 16,000, 60,000. You have to pay 30% tax, 18,000 rupees as tax. Plus you have to pay 2,000 rupees as tax again for payment of TDS. So payment of TDS is applicable, interest is applicable, penalty is applicable. Plus income tax is applicable on non-payment of TDS or non-deduction of TDS, and tax is computed on 30% of 30%. 2 lakh rupees into 30%, 60,000. On that 30%, 18,000 rupees. You see the consequences. Very, very important. This is an amendment particularly to charitable and religious trust or institution. If the tax is deducted in the subsequent year or deducted in earlier year, but after section 39(1), the expenditure will be allowed in that year, as usual in the case of business or portion. So this is what I said, 30% will be disallowed. 30% of the amount of expense will be disallowed in case such NPOs do not deduct any TDS. This applies to NPOs governed by section 1023C also. Next. Disallowance of expenditure. 40A3 or 3A provides for payment of expenses exceeding rupees 10,000 by cash, daily payment, cash payment exceeding rupees 10,000, then it will be disallowed and tax will be computed. So in the computation of income, after 15% deduction of gross receipts of 15% of gross receipts are deduction, the balance amount may be 0. 100 rupee is the gross receipts, 100 rupee is the gross receipts. From that you have deducted the revenue expenses, capital expenditures, etc. And from there you have deducted 15% salary deduction. Balance is 0, but still you are liable to pay tax on the ground that TDS is not deducted under section 40A1A or payment exceeds rupees 10,000 as per section 40A3. So as per the computation according to the section 10, 11, 12, etc., surplus is nil. But when you compute your deduction on account of non-deduction of TDS or payment exceeding rupees 10,000, then you are liable to pay tax as mentioned above. With this, friends, let me go to the final part, which is called assessment. Today, your assessment will be conducted by the concerned jurisdictional assessing officer. As per section 144B, it is called a faceless assessment. In most of the cases, the officers are not seeing the assessee or the authorized representative like chartered accountants or cost accountants or advocates, but the assessment will be completed by the authorities to conduct the faceless assessment. The authorities may be National Faceless Assessment Center, NFAC. The assessment procedure under new faceless proceeding regime by different steps. We have about 1 to 15 steps. I'm not going to discuss about these steps. And the communications between different entities through electronic media, through National Faceless Assessment Center. You will get only notices through electronic media. But when you come across a cases where your personal presence is very much required, you can apply. The assessee may request for personal hearing so as to make his oral submissions or present his case before the income tax authority in any unit. Approval may be granted for personal hearing by the Chief Commissioner of Income Tax through video conferencing. Therefore, personal hearing is rarely applicable on your request. Next. Now, I would like to mention the recent notice for the benefit of all of you here. There is a recent notice In the notice, there is a prescribed format as per annexure. Number 1, date of creation of the trust. With the registration certificate, activities, objects of the trust supported by trusted deed. Number 3, trusted deed or bylaw or memoranda or etc. Number 3, copy of audit report in form 10B or 10BB. 10B is applicable under section 12AA. 10BB is applicable under section 1023C. Report in schedule 9C under Bombay Public Trust Act 1950. Computation of total income in the following format. In the format, you can see the gross receipts as I mentioned, less amount applied for charitable purpose, including capital expenditure. Then balance is called surplus. From there, you can deduct 15% of the above. 15% of the above, they have mentioned net surplus and not gross receipts. Here I have a different view, my dear friends. As I have mentioned the income tax appellate tribunal Bangalore bench case laws, what is income? Income means gross receipts. Here they say it is 15% of the surplus, net surplus. Net surplus means gross receipts minus the revenue expenditure minus the capital expenditure. Therefore, 100 rupee minus 85 rupees or 50 rupees, so 50 rupees, then balance 15 rupees. So 800 minus 50, balance is 50, minus 15, that is standard deduction, 35. On 35, or we can say 100 minus 50, that 50 includes capital and revenue expenditure, balance is 50. On 50, they say 15%. But here I have a different view. It is not 15% of 50 rupees. It should be 15% of 100 rupee only. You may have different views, but my view is that this is a mistake. It is not in accordance with the section 11. Section 11 provides for income, computation as per income. Income 15% of gross receipts and not 15% of net surplus. Here they specifically mention not gross receipts, but it is not accordance with the section or provision act. It should be corrected. The amount under section 11.5 with the proof. Here you can see, for example, your gross income is 100 rupee, capital expenditure, revenue expenditure 50 rupee, balance is 50 rupee, 15% of 50 rupees, that is, or 15% rupee, that is 15. So 50 minus 15, 35 rupees. Now friends, out of 35 rupees, if you want to claim exemption by way of accumulation under section 11.2 for 5 years or 11.1 for 1 year, this 35 rupees should be in your balance sheet under bank balance or the balance as prescribed under section 11.5. Here, if you have deposited in a cooperative society, which is not a banking company, you are not eligible to deduct. If you are depositing in a private finance or you are giving for loan to other concerns, it is not deductible. There are so many case laws. Advance given to other trusts, which is not deductible under section 11.5 is not applicable. Therefore, you must be very clear, very clear about this investment under section 11.5 for the purpose of computing your income. If it is not in accordance with 11.5, you are liable to pay tax at the rate of 30%. Next. Now, we have next. Number 4, I am mentioning this notice. Place where from place where the trust or institution is operating its activities, whether the premises are owned by rented or etc. So rent agreement is required. The details of payment of TDS, place where the trust or institution is operating its activities, then a copy of the lease deed, details of all branches, list of trustees. Here it is very important. List of trustees with the name, address, etc. Next. PAN. Details of transactions of sale of capital assets covered by section 11(1). Details of transactions of sale of capital assets. Sale of capital asset means the land, building, etc., which is a capital gain. So that capital gain is also eligible for application of funds for investing in another property. Details of funds transferred to other trusts in the following format. You have to see amount applied for charitable purpose excluding transfer to other trusts. Amount invested out of funds, income received during the year. Amount transferred to other trusts. So if it is for corpus fund, not deductible. General donation and similar objects, 12-way registration, it is applicable. Here I must mention that if you are donating to a religious trust by a charitable trust, this deduction is not eligible. Religious to charitable to religious trust. Charitable to religious trust is not deductible, whereas religious to charitable trust is allowed. So very important. And loan given also not an application. Next. Details of loans taken during the year. Year of taking loan, name of the institution, purpose of taking loan, amount paid. Suppose the loan is taken in earlier years, you have to produce the auditor statements of the earlier years also, the year in which the loan is taken. Whether the trustee has given any donation to any other trust, institution from corpus fund during the year. Suppose you have given as corpus donation, you have to disclose it and not eligible. Details of foreign contribution, copies of bank account, copies of audited accounts. In the case of FCRA, you have to prepare separate books of accounts and you have to maintain separate audited statements of accounts. In addition to the audited accounts of the institution. Next. Copies of resolutions passed by the trust or institution, minutes book, books of accounts, movable and immobile property register. In many trust or institution, the fixed assets register is not maintained. So hereafter, you have to see to maintain, you have to ensure that your institution has maintained proper books of accounts and fixed assets register. If there is substantial receipt declared as other income, so in the case of business income, you have to maintain separate books of accounts and you have to pay tax on business income. Provide the details of accumulation of fund and whether the same have been invested as per section 11(5). This point I have already mentioned. When you accumulate the funds, you have to ensure that the fund is invested in accordance with the section 11(5). Finally, friends, provide the details of persons covered under section 13(3) of the Act. What is section 13(3)? 13(3), the author of the trust or the founder of the institution, the persons referred to section 13(3). Any person who has made a substantial contribution to the trust or institution, that is to say, any person whose total contribution up to the end of the relevant previous year exceeds ₹50,000. Here it is very, very important. I repeat, as per section 13(3)(b), any person who has made a substantial contribution to the trust or institution, that is to say, any person whose total contribution up to the end of the relevant previous year exceeds rupees 50,000 rupees, exceeds rupees 50,000, which means I have a public charitable trust and another person, maybe an individual or a religious trust or a charitable trust, and that trust has given me a contribution of say 1 lakh rupees. I have a public charitable trust. Another trust or an individual has given me a 1 lakh rupees contribution earlier. Now I am paying 2 lakh rupees contribution to that trust or individual. Then you read the section 13(3)(b), any person who has made a substantial contribution to the trust, that means the other person or an institution or a trust has given me 1 lakh rupees as a contribution, and that contribution I am making a contribution of 2 lakh rupees to the other person or the individual. At that point of time, this 2 lakh rupees will not be considered as an application of fund, because the section 13(3) subsection 13(3)(b) says the whose total contribution up to the end of the relevant previous year exceeds rupees 50,000. That 1 lakh rupees is exceeding rupees 50,000. Therefore, when I pay 2 lakh rupees, section 13(3) applies and I am not eligible to claim as deduction. This is happening in many institutions in India. Earlier they have given some contribution. Today I am giving contribution to them, and earlier contribution up to the end of the relevant previous year was exceeding rupees 50,000. Here there are two views. What do you mean by contribution up to the end of the relevant previous year? Whether it is from the day one or during this current year only or this year only. My view is that we have to consider only current year, because assessment is on yearly basis. But there may be another view on this area. It is left to the learned friends. This is very important. And what is the definition of person? Person includes individuals, HUF, association of person, company, trust, etc. Therefore, if there is any judgment from any court that person, individual is not included, or the registered trust is not included as person, then it is well and good. Or an amendment is required in this area. 13(3)(c), where such author, founder or person is a Hindu undivided interest. Any trustee of the trust or manager, whatever name of the institution called in, whatever name called of the institution, any trustee of the trust or manager, that means any trustee or trust of the manager, which may be trustee or trust of the manager, maybe the reasonable salary is eligible. That is already provided in section 13. Reasonable salary is allowed. Any relative of such author, founder, person, member, trustee or manager as aforesaid. Any concern in which any of the persons referred to is a substantial interest. What do you mean by substantial interest? Any lineal ascendant or descendant of the spouse of the individual. Substantial interest in a concern, if such person is entitled, or such person and one or more other persons are entitled in the aggregate at any time during the previous year, not less than 20% of the profit of such concern. So in the case of charitable institutions, this 20% of institution, 10 any income thereof, directly or indirectly, for the benefit of any person. Next. Therefore, previously, as per section 13(1), in the case of a trust or religious trust, trust for charitable or religious purpose, or a charitable or religious institution, directly or indirectly for the benefit of any person referred to in subsection 3. Why I have mentioned subsection 3 of section 13? Because if you make any payment to such person, this income is not eligible to apply for charitable or religious purpose. Therefore, first I have defined what is section 13(3), and 13(1) says disallowance. And similarly, section 13(9) provides for, next. Section 13(9) says, if the return of income for the previous year is not furnished by such person on or before the due date. I have already mentioned, if you fail to file the return, then you are not eligible to claim exemption if the return is not filed within the time limit. There are also some case laws. What is the time limit under section 13(1), 139(1), etc. So the relative is also defined. Next. So with this, friends, I have covered all the areas relating to return and the registration, return and assessment. Over to the chairman.
Sir, one question has come in the chat box.
Yes, sir.
Forms for renewal of 12AA and LTG, is it the same as for registration, or it to be notified?
Renewal is not a registration. Renewal is the existing registration. Existing applicants can file an application for renewal. It is not a new registration. Under section 12AA, you have already obtained a registration certificate, or section 12A, you have obtained a registration certificate. Under section 1023C, you have already obtained an approval. Under section 80G, you have already obtained an approval. Therefore, it is only a renewal, not a new registration. But please note that almost all the documents are required.
What is the expiry date of existing registration? That is another question.
Yeah, the date of validity of the existing registration is only up to 31/3/2021. Within 3 months, that is from 1/4/2021 to 36/2021, that 3 months period, they should apply and comply with the renewal procedure.
Okay, sir. Next question, whether the amount of TDS disallowance is to be reduced from application of income, or shall directly to be shown as income of the trust? Please advise how to disclose the same in the IT return.
It's a very good question. The answer is, unfortunately, I am not able to give favorable answer to the participant. Yeah, which means over and above the computation as per section 11(1) and 11(5), you will get a figure that may be nil. Then you have to compute the disallowance. Therefore, the total income may be nil as per the computation in accordance with the section 11, 12, 13, etc. But if there is a non-deduction of tax, the income is to be computed as we do in the case of profits and gains of business or provision, and therefore if that disallowance is above 2,50,000, you have to pay tax. Otherwise, you are not liable to pay tax. That basic exemption of 2.5 lakh is eligible. Next question.
Jose, you are muted. Unmute.
Oh, sorry. In the case of an unregistered religious or charitable trust, under which head income is computed? What are the expenses that can be claimed as deduction from income in such case? Can they claim depreciation as a deduction?
They are eligible to deduct revenue expenses and capital expenditure. Revenue expenses means day-to-day expenses. Capital expenditure means land, building, etc. Unfortunately, they are not eligible to deduct depreciation. If you claim depreciation, it is a double deduction. Therefore, sorry, they are not eligible for depreciation deduction. But when you are not claiming the capital expenditure, then you can claim deduct depreciation.
Okay, sir. So next question, the organization registered under Trust Act but not obtained 12AA registration was being taxed at 30%. Is basics exemption of 2.5 lakhs will be available for this such a trust?
Answer is yes, available.
Sir, when the application shall be made for renewal in the case of existing 12AA registration trust, is there any due date or extended due date to COVID pandemic?
Yeah, the extended due date is up to 31st March 2021 and you have 3 months time to comply with that. Due to COVID 2019, the time limit is extended up to 31/3/2021 as per the Taxation Amendment Act notified by the government.
Okay, thank you, sir. There are few more questions in chat. Participants, kindly post your questions, queries in Q&A session, if you don't mind. What was the limit of 2,000 rupees mentioned? Donation to trust or just for political parties?
Yeah, donation to trust in cash up to 2,000 is eligible. About 2,000, the donor will not get any deduction if it is paid by cash. If it is paid by check, he is eligible 50%. We are talking about charitable trust, not political parties.
Okay, sir. This existing 12A trust has to apply for renewal only under the new 12AB. In what application form? Is it the earlier 10A form?
So far, the government has not prescribed a new form for renewal. Therefore, they should amend the rule as per in accordance with the section 12AB. A new form 10A is to be prescribed. If it is not prescribed, we can apply only by using form 10A.
Thank you, sir. Next question, whether trust other than educational institution do tax audit?
Yes, in the case of a trust having business income, for example, a hospital or a printing press or any other business activities, they should get their accounts audited as per section 44AB of the Income Tax Act.
Yes, sir. Next question. What is the procedure for new registration? That is online application regarding form, etc. I think the question is about whether the new registration is under online or not.
The new registration is only through online.
How many years a trust need to keep or maintain the books of accounts?
As per income tax law, you have to maintain 6 years.
6 years. Okay, sir. And renewal is valid for how many years, sir? That is another question.
The renewal of registration is valid for a period of 5 years.
Whether basic exemption applicable to all the trust?
Yes, basic exemption of 2,50,000 is applicable to all trust.
Okay, next question. A charitable society not registered under section 12AA has received donation and used them for charitable purposes. While filing the income tax return, can the trust claim the charitable expenses or will the gross receipts will be taxed?
Can you repeat the question once again?
Yeah, one charitable society not registered under 12AA has received a donation and used it for charitable purpose. While filing their income tax return, can they claim the charitable expenses? That expenses are say charitable expenses, or will the gross receipt will be taxed? I think the question is whether they can reduce this charitable expense from their revenue.
Answer is they have to take the gross receipts as donation, and from there all administrative expenses can be claimed as deduction as revenue expenses. The answer is yes.
Okay. The interest income earned as a medical aid by an educational aid, can we go ahead without 12AB registration and file ITR applicable for AOP, because the future gross income will not go above 2.5 lakh rupees, which will be donated as medical and educational aid?
The answer is yes. You can file your IT return by showing gross receipts less administrative expenses and file income tax return. If the gross income is below, the net income is below 2.5 lakh after administrative expenses, you need not pay tax. If it exceeding that amount, 30% is to be paid and file the return. Yes, it is possible.
Okay, sir, that is the end of questions in chat and Q&A box.
So, thank you all. I am very happy that more than 224 delegates participated, and I must also thank the chairman, CA Roy Varghese, Joman K. John, Ranjit, then Jos, and all the committee members. I may conclude once again by saying that if you salute your duty, you need not salute anybody. But if you pollute your duty, you have to salute everybody. In these few words, thank you very much. Thank you all.
So I think it's our privilege to thank you, because